לכולם, תודה שבאתם בעוד אירוע של מכון G-City באוניברסיטת רייכמן. היום אנחנו מארחים כלכלן בכיר מ-JLL, גם את הכלכלן וגם את JLL תציג מור זיו, ואני עכשיו אעבור לאנגלית כדי להציג את הטייטל שלה ובכלל יתרת האירוע תהיה באנגלית. So welcome, happy to see everybody again in our meeting of the G-City Real Estate Institute at Reichman University. We are hosting today an economist from JLL, Mor Ziv, head of international capital coverage from JLL, will introduce our speaker, and thank you, Mor. The floor is yours.
Thank you, Efrat. Hey everyone, shalom lekulam. Welcome to an incredible webinar hosted by Reichman University and JLL. JLL is the leading global professional services firm with over 100,000 employees operating in more than 80 countries, managing 4.6 billion square feet of real estate assets and transacting approximately $170 billion in global real estate annually. We are super excited from JLL as our guest speaker today. He is here to talk about the global real estate outlook for 2024, and he'll be sharing some awesome insights on the hottest trends and prediction that will shape the industry. Thanks for joining us, and get ready for an amazing session with David.
Well, thank you very much, Mor. You have certainly bigged me up, and hopefully it will be very interesting. Now, there aren't a lot of us online, and we have quite a long session. I do not propose to be speaking for the entirety of this time, and I would strongly encourage you, if you have any questions, to raise your hand, put something in the chat, or interrupt me as we go. I may not be able to see everything while I am sharing some slides, so I'm sure Mor will interrupt and speak on your behalf. And I would also suggest that if you are a guest, that you might wish to turn your cameras off, as this session is being recorded, and the film of you on camera, as well as me, Efrat, and Mor will be sent around to other attendees of the university. So with that, I'm going to share my screen and begin. As Mor said, my name is David Ray. I'm Chief Economist for EMEA at JLL, and I also have some responsibility for our global macro research program. The origin of what I want to talk about today is our look ahead. And each year we take a view on what's likely to happen in 2024, 2025, and so on. And we tend to publish a variety of different research pieces from some articles, some content covering capital markets, some content specifically for occupiers. Now, we can't cover everything, and in fact, just trying to change my view here. If we were looking at all the trends, all the major trends that are affecting real estate, we'd be here for days. And I do not propose to do that. We have a much shorter session, and so I would like to cover a number of these trends in a varying level of detail. And so what I'd like to go through is 9 of the major trends that we think will have the biggest effect this year and next year. Now, these are parts of longer term trends as well, but their main impact, the main way that we will see it being felt within the real estate sector, is over this year and next. These are uncertainty. There's a great deal in the wider economic environment and also in the real estate landscape. Green shoots of recovery. So against this difficult backdrop, there are positive areas. The climate for investors is another theme that I will touch on, as well as the construction outlook. A massive topic within real estate, particularly in the offices sector, is hybrid working. So I will cover how that is playing out and where we're reaching an equilibrium. And another sector that's seeing a lot of positive growth across most markets, as well as some challenges too, is the logistics sector. Some really interesting things going on there. I will touch on AI and tech. I am very much an economist and look at the world of economics which to me is human behavior and human decisions and interest rates and inflation. I am far from an expert on AI and tech. So if you have any questions on that, I'm very happy to forward them to some of my excellent colleagues who know a lot more about that. But I will cover some of their research into how AI is evolving and will affect real estate over the next year or two. And ultimately, I would like to go through ESG, or environmental, social, and governance trends, which is a thread that really runs through all the others, but most of the sectors, most of the trends affecting real estate at the moment have an ESG component. And lastly, touching on some of the implications of the above for offices. And as I said, if you've got any questions, please do interject. If you wait right till the end, you might have forgotten what was being covered in each section. I will do a short pause, a couple of seconds between each one. Let me begin then with uncertainty. Now, it will not be any surprise that we are going through a globally uncertain time at the moment. We have a huge number of elections this year. We have conflict right on your borders, on the borders of Europe as well, with Ukraine, as well as further into the Middle East as well as some conflict in Central Africa and the risk within of a Taiwan-China conflict, and also policy. There are some huge questions about what will happen with policy, not just interest rates, which I will touch on today, but also fiscal policy post-COVID, post-pandemic fiscal cuts, as well as a US government shutdown, which has a big impact on financial markets globally. These geopolitical risks, this uncertainty is elevated. It feels like this has been the case for several years now. You could call it a new normal, but certainly it is something that we need to acknowledge and live with, as well as build into any of our real estate forecasts and expectations. Now, one interesting thing on elections is this chart, which I've taken from The Economist. And from their analysis, 2024 will be the biggest election year in history as measured by the number of people eligible to vote. It doesn't mean it's the most number of elections, but it's certainly the most number of people who could vote, which in terms of its potential impact could mean a change in policy, certainly a change in government. If you look to the left of this chart, you have more authoritarian regimes. I certainly don't think anyone is expecting a change in government in Russia, but as you move to the right and have more democratic regimes, there is quite likely to be a change in the political setup in the US. Certainly, Donald Trump is on course to, well, he's now the Republican nominee and he is ahead in many of the polls. And where I'm calling in from today from the UK, we have a general election coming at some point this year, and it's very likely to lead it to a change in government. And this compounds that scene for uncertainty. One of the other elements that's affecting real estate globally is through the supply chain element, and that is the Houthi rebel attacks that are affecting international shipping as it passes through the Suez Canal. You can see, and I will put up probably quite a few charts in this presentation. I call it my economic spaghetti to go with the bubbles of trends that we saw before. And we can see from the ones here that the pandemic, as is well known, had a big effect on global shipping. You can see the impact on vessel schedule reliability on the left, on the average number of days on the right, and where we were getting back to the pre-pandemic average, or we're almost there, that trend has now reversed. And as of December, we saw an increase in shipping times from East Asia to the Mediterranean, ships having to go via the Horn of Africa rather than through the Suez Canal, as well as an increase in shipping time to the US. So this background of uncertainty of elections, conflict, and policy, that feels like a very negative setup for the year. And whilst that's true, I think actually we despite this, we do face an environment of greater predictability, or at the very least, greater relative predictability. And by that, I mean relative to the last 2 years. And there's 3 topics there: inflation and prices, interest rates and debt costs, and economic stability. So these, whilst there is change and uncertainty about them, there is much less than we've had for the last 2 years. Let me begin with inflation. taking that global perspective, we did see a big increase in inflation. It might not look like it was much in Japan or in other Asian countries, but for what they were used to, it was quite a big increase. We are now seeing inflation falling back. And I put up two lines here. One is that headline measure of inflation, the one that we all know, we read in the papers, but also the core measure of inflation, which excludes the volatile items of energy, food prices. And I exclude that because certainly in some areas, it was energy prices that was a big driver of the increase in inflation. In the Eurozone, Russia's invasion of Ukraine had a big impact on energy prices. That had a massive effect on inflation in Europe. For the US, it was more of a demand-driven story. Stimulus checks driving strong demand while supply chains were still negatively affected by the pandemic. There was also an energy element to it. Now, as we look to the future, that core inflation is coming away, tells us that underlying price pressures, underlying supply and demand dynamics in an economy are reverting back towards normal. We can take some confidence in this, that inflationary pressures are easing. Now, the question is, why does this matter? It matters because when inflation is high, it becomes unpredictable. High inflation begets high inflation. It drives high inflation. When inflation is low, the price of any good or service depends on its demand and supply fundamentals. When inflation gets high, the price of a good or service becomes correlated with other goods and services. So it becomes self-fulfilling, self-perpetuating. And as you look to the future, you cannot then predict what future inflation will be, what the future price of any good and service will be, because it's no longer dependent on its demand and supply conditions. So as we get back towards low inflation, and here I'm showing the forecasts for inflation for these three main jurisdictions, it's heading back towards that 2% target, the 2% target of the major central banks over the next couple of months. And this means that inflation will become predictable again. We'll be able to look into the future and we can say, we've got 2% inflation now. We can reasonably expect 2% inflation in a year's time, in 2 years' time, in 5 years' time. So we're better able to predict prices, better able to predict costs, occupational costs, operating costs, as well as construction costs, consumer prices, and so on. Now, there is a risk to inflation that gets talked about quite a lot in Europe, of the disruption to global shipping that I touched on before from those Houthi rebel attacks. And you can see from the chart in the middle, this is a chart of the cost of shipping a container from China, the Far East, to Europe. You can see in COVID, it went from $2,000 per container up to above $14,000. And this time round, we saw it from around $2,000 to above $6,000. That's come off, but there are still concerns that this could upwardly influence inflation. Now, I think those concerns are overblown. There is some justification, and I've put some of these factors on this slide. In terms of the justification for concerns, over on the left are the aggravating factors. The main one really is uncertainty. If there is uncertainty around supply chains, the ability to get goods to markets, particularly as we go through the year and get towards more of a Christmas trading period, which is one of the big ones, as well as the Black Friday, and shops start stocking up from September onwards, or even late summer, that uncertainty could drive higher precautionary inventories, which would drive the shipping cost higher, drive the cost of goods higher, and have an impact on inflation. And from a broader economic perspective, we do anticipate there will be some improvement in economic conditions in the second half of the year, which could mean stronger demand for shipping. However, I think these factors are outweighed by the mitigating factors, and there are two big ones here. The first one is that global shipping already was experiencing excess capacity before this supply shock. Ships were being told to go more slowly on their routes than they would normally because they weren't wanted to be stood empty at ports waiting to be filled or unfilled. There was capacity, there was slack in the system that could take it up. On a fairly minor note around inventories, Well, manufacturing in Europe and North America has been in recession for a year and a half. Inventories are low. They are where businesses want them to be. And that's the same from a consumer spending outlook, from a retail perspective. So there are no signs of precautionary or demand for precautionary inventories. Firms and manufacturers have them where they want them to be, which is pretty low. Second big reason is during COVID, we saw that big increase in shipping cost containers at the same time that we saw a big increase in energy costs, at the same time that we saw a big increase in metals costs, food commodity costs, other raw commodity costs. This time around, we're not seeing that. We've recently seen a small tick up in the oil price, but for the most part, this increase in container costs is being offset by low or at least low and stable commodity prices. And so when it comes to the net aggregate effect, Goldman Sachs estimate that the disruption to shipping will add 0.2 percentage points to global inflation, which is effectively a rounding error. And Oxford Economics estimate that disruption will add 0.4 percentage points to European inflation. So if Eurozone inflation gets to 2% at the end of the year, well, it might actually be 2.4% as a result of the disruption. Not substantially different, not enough to change the implications of the inflation rate. Now, one of the big implications for inflation is what does this mean for interest rate policy? And activity within the real estate sector, particularly the investment sector, but also influenced in the occupier market as well. Interest rates are a huge determinant of activity. And we are now at a tipping point after 2 periods of exceptionally unusual monetary policy. The first period was that gap after the global financial crisis where interest rates were, for the most part, very low and unusually stable. And then this was continued into COVID, where rates were cut back again or cut further. That was very unusual. Subsequent to that, from 2022 to the end of 2023, we had the second unusual period. And this was unusually fast, unusually aggressive and unpredictable monetary policy tightening, rate hikes by major central banks. Not every bank moved. In fact, the Bank of Japan still hasn't raised interest rates, though it's expected to do so in the coming months. China cut interest rates, but its economy is in a very, very different situation. But a lot of the major central banks raised interest rates in a very unpredictable way. We are now at that tipping point where we could say, well, it looks like they're stable and they will be coming back down. And the inflation picture is an important driver of that, an important driver of the predictability of where interest rates go next. Interestingly, though, it's not the only driver. Although the ECB and the Bank of England have explicit inflation target mandates, the US Federal Reserve has an explicit inflation and employment mandate. Central banks have other considerations as well. In the US, growth is incredibly strong and forecasts have been revised up, which could warrant holding interest rates higher for longer. It's the flip side in Europe, where the UK is or was in recession at the back end of last year. Germany was in recession at the back end of last year. That would warrant looser monetary policy. And they also need to take into consideration credibility. The major central banks, with the exception of Central and Eastern Europe, which were quick to act, the majors were too slow. Their credibility was damaged. So they need to consider whether they need to act early. Do they move in advance of inflation hitting that 2% target to take interest rates back down or not? Do they risk that hit to credibility again? And in the US as well, there is the further consideration of the election. The Federal Reserve does not want to be perceived to be interfering or doing anything that could have an effect on the election, which really means it has a window where it can't act. And I would say that's probably from May right up to the election in November. If it acts beyond May, people will start to experience the benefits of interest rate cuts quite close to the election. So really, it either needs to act early or wait until the election result is out the way and then act. then it could not even have the perception of interference. And then there's some other considerations for central banks as well, one of which I'll come to in a second about financial conditions. But broadly, even despite the recessionary environment in Europe, or even the strong environment in the US, labour markets have held up particularly well. Employment remains high, unemployment low, wage growth is relatively strong. A lot of central banks are worrying unnecessarily about wage inflation. And I say unnecessarily not because it is a factor that can be easily dismissed, but because wages were eroded very substantially by inflation. And now as we look to the future, that higher wage growth than inflation is just restoring purchasing power, restoring real spending power to where it would have been. It's like two waves at a beach. That first wave is inflation, that second wave is wage growth. It's not that one is driving the other or one is going to cause the other to have a change in effect. It's that they come at different times. Now, where will interest rates go? 2 points I want to make here. One, the direction of travel is downward. It seems pretty clear that markets, economists, central banks themselves look to the future and say rates are coming down. We've got that greater predictability. That is going to be beneficial for the real estate sector because debt costs will start to fall. We'll just be able to close that gap between bid-ask spreads between buyers and sellers, and we'll have less of an impetus of the effect on prices. Now, that's the first point. The direction of travel is downwards. The second point is there remains a lot of uncertainty around it. And I've shown here the financial market view of where policy interest rates will go as of the beginning of January, the beginning of February, and the beginning of March. If you were to show December as well, it'd be another completely different line in another place. But the point is, there is uncertainty. Financial market views are changing all the time, from day to day, from week to week. And with any data point, these lines will shift about. So although we've got some predictability about the direction of travel, we still have some uncertainty about when rate cuts will come and how far. Now, interestingly, there's a survey that was out last week that looked at lots of economists and their views, which are a little bit of a step back from the noise of the financial markets and put into actual decision terms by the central banks. And that view was 3 cuts from the Federal Reserve by the end of this year, 3 cuts from the ECB by the end of this year, and 3 cuts from the Bank of England for the end of this year. Their perspective on the Bank of Australia wasn't published this month. So that provides at least some greater clarity. So what does this mean? Well, I've set it up with uncertainty being a big theme, but actually it's about the return of predictability, or at least relative predictability. And this decline in inflation provides greater predictability about prices. The stability in interest rates provides greater predictability of debt costs, predictability and stability in debt markets, which we think will be in a big driver of improved investment transaction activity. Where we have seen volatility in real estate prices, and by volatility, I mean falls, we think that will stabilize. We also think, as we look to what this means for investors, that if you're an investor able to act, then there will be considerable first mover advantage. If you can act and deploy your capital effectively and quickly, there are buying opportunities, or indeed leasing opportunities this year, that if you wait to 2025, those will be gone. There was a mantra that we heard back at the back end of last year when writing these trends, and it was survive till 25, fix in 26, and heaven in 2027. We disagreed fundamentally. I thought if you wait as an investor or a business looking to lease property till 2025, you will have missed out on opportunities in this year. You will have missed out on the best buildings, the best spaces. And ultimately, there is a benefit. If you're thinking, you know what, prices are falling, we think they'll go back up. If you're buying very near the bottom as it's coming back down, then you're still going to have the same cost in a year's time, but you've got less competition. And so our take is then this more stable landscape offering opportunities will allow investors and occupiers to execute on their portfolio strategy, buying more properties, selling more properties, leasing more properties, whichever way it is, in a way that was impossible given the volatility of pricing, debt, interest rates in 2022 and 2023. So that was uncertainty. I'll pause briefly before moving on to green shoots. So please come in if you've got any questions. I'll take that as a no, so I'm carrying on. So our second trend was, we're saying we think there's going to be opportunities emerging in 2024. This trend is, there already are some there now. There are already some green shoots of recovery. Part of that story is the growth story, that we can see that conditions are broadly, as we move around, as we look around the world, on an improving trajectory. I realize in hindsight, I should have put on 2023 so we could see how that trajectory is improving. Broadly, there wasn't a lot of difference. The countries on the left, the countries on the right, the Canada, Eurozone, Germany, and UK, are going to be doing better in 2024 than in 2025. Those in the middle, about the same. And those on the left, it's slightly worse this year. But it's quite a different story in emerging markets. So broadly, we're moving from difficult conditions in 2023 to slightly better on average in 2024. And as we look ahead to 2020, in fact, I'll tell you what, I'm sorry, I should have covered it. The black horizontal lines are the median GDP growth forecasts from the consensus for this year, for 2024. So picking the country in the middle, looking at Japan, that black line, 0.7% is the estimated GDP outturn for this year. That's up on 2023. For the UK, it's 0.3 for this year. For India, 6.9. The beige bars show the range of forecasts. That's from the most optimistic at the top to the most pessimistic at the bottom. And I put those on just to indicate that level of uncertainty, really just compounding the last point I made. The purple bars are the forecasts for next year. How will growth evolve between this year and next year? And you can see for all the countries from Australia to the right, we're on an improving trend. Growth forecasts are due to pick up this year and strengthen into 2025. Now, the US is a bit of an exception here, only because forecasts were revised up so much since the start of the year. At the beginning of the year, it was estimated the US would see a 1.1% expansion this year, which would have been right at the bottom of that beige bar for the US. And the economy's done far better than expected, so the forecast has been revised up to 2.1. Ostensibly, though, it's a good year this year for the US, good year next year. And for most other countries, with the exception of China and India, where it's comparable, we're on an improving trend. So the growth outlook is getting better. And if we look at real estate and real estate portfolios, it's not all bad news either. A lot of talk is, oh, the office is dead. Well, that's not the case at all. There is a lot of change within the offices sector. 48% of companies that we've surveyed have said that they will reduce the amount of space that they're going to take. That's not all in 1 year, that'll be over a period of years. But 29% have said that they want to expand their portfolios. They want to take more space. And for the most part, they want to take better space. And even those looking to reduce their portfolio want to reduce the overall size of their portfolio, but want to improve the quality of it. So we might be seeing a net reduction in footprint overall, but we're definitely seeing a move up the value chain across investors and across occupiers. And I think the interesting takeaway from this is that means the office isn't dead. There are green shoots within the sector. They are very much concentrated within those higher quality assets, those in the best locations, with the best ESG credentials, with the highest wellness certification. Those are the properties that everyone wants, even those companies that are cutting back on their portfolio. Now, if you dig a little bit deeper within those two figures, the red bars add up to that 48% and the green bars add up to that 29%. there is a bit of variation within there. Some firms are going to be cutting enormously, some firms will be growing enormously, but it's interesting to see how this overall picture will change over the next 3 to 5 years. There's opportunities there for big growth, big changes. That's just on the offices side. If we have a look a bit wider, and this is purely looking at the investment side, we can see that some sectors are doing quite well. Now, what I'm showing here on this chart is an index we've constructed in-house called the Global Bid Intensity Index. And this looks at a number of different variables related to an investment transaction, from the number of bidders to the spread of the bids to what the final price was in comparison to the asking price, where a number below 100 indicates that bid intensity is worse than it was pre-pandemic, worse than it was in 2019, and a number above 100 indicates it's doing stronger than it was in 2019. And you can see all those lines there, one for industrial logistics, one for living, one for offices, and one for retail, all dropped down in 2022 when the sector overall took a nosedive. And it took a nosedive globally, most acutely in the US, quite intensively in Europe, and less intensively in Asia Pacific. But you can see here, looking at this chart, that light blue line for offices still remains struggling. It's still well below that 100 line. And that's because it's global, because the US office sector, for instance, is really struggling, and it's going to have another very difficult year. It's still got the benefit of that 29% of companies looking for higher quality portfolios, or higher quality spaces, but there is also a huge amount of obsolete assets, space that is 10, 20, 30 years old that nobody's going to want as we move into the future. And as I come to hybrid, the story will unfold a little bit more, insofar as the US hasn't seen the same level of return to the office and office utilization as you've got elsewhere. Retail's getting back to 100%, but you can see particularly the industrial and logistics index has soared back away. Now, industrial logistics got a big boost during the pandemic as lockdowns led to a lot more buying of goods and services, a transfer of that spending. That reverted a lot during 2022, but it's coming back. And industrial logistics is one sector that we see globally as being a green shoot, where there are good opportunities. But again, good opportunities at the top end of the spaces with the highest ESG credentials. So pulling it all together then, for that green shoots, where do we look? Well, I mentioned retail's coming back. That's partly because pandemic-related disruption to shopping habits, to international trade, as well as to office use habits, it's unwinding, which helps us to be able to discern the noise from the signal. In India, the retail sector is coming back because of a change in some of the positioning of shopping centres, the launch of new REITs for shopping centres in India. There's a similar thing in China, which is driving the retail sector to positive. In Europe, living is benefiting from long-term structural trends of aging populations, urbanization, and the trend to small families. So it's hardly even a green shoot because it's always been doing well. And particularly in the US, and I will come back to this again later, AI and the immense strength of the tech sector at the moment is driving a lot of adoption of not just offices, but of industrial assets as well, around data centers and other AI and tech related infrastructure. So there are some really good green shoots emerging, slight differences depending on the region. Again, I'll pause in case anyone wants to come in. Give my voice a chance to rest for a second. And then moving on, so investors. There are a couple of trends here that I find interesting from the investment point of view. One is around asset allocation. So as a result of falling real estate prices, higher interest rates, so higher debt costs, high leverage costs, and a compression in the spread between the real estate yield and the borrowing cost. Real estate investment transaction volumes fell 50% globally. It looked like real estate was not in demand, that as a sector, it was going to really struggle. And you can see from the chart in the middle that investor asset allocation dropped back to 8% in 2023. Well, looking ahead, speaking to investors using other different sources and from our own internal intelligence, we think this is just a blip about an otherwise upward trend. And I put on this chart that rising trend from 2016. If you go back further, it's similarly noisy, but it is on a rising upward trend. Real estate remains an attractive asset because of, as I put on the left-hand side, low volatility, low correlation with other assets. It's got some inflation protection, a stable income profile, as well as diversification benefits within a portfolio. So although it's got some temporary setbacks, we still think that investors are going to increase their allocation to real estate over this year and next year. This is going to have a positive impact, a positive impetus to the sector, and it will help drive investment allocation or investment volumes into real estate back up. Now you can see I pop another chart in on the right, net allocation intentions, and real estate's that one in blue. The allocation is, sorry, let me start that again. Yeah, the intention is to increase the allocation to real estate over this year, put it out of cash, which is not yielding as much as elsewhere. So that is another investment trend that we see coming. And if we turn that into actual numbers, as you can see, if you look to the right, in 2023, investment volumes had fallen more than 50% compared to where they were in 2021 or 2019, which is clearly massive. And this is only EMEA. This was replicated in the US as well, or even slightly more acutely. And in real terms, so adjusted for inflation, this would leave our transaction volumes in 2023 basically on par with where they were in the worst year of the global financial crisis. So you can see in 2019, the actual outturn was 77. If we put this in 2023 prices, 2019 volumes would be 155 billion, which I put in as that red line. So that was a massive drop-off. But as we look ahead, our forecast is 170 billion euros of investment transaction activity across EMEA this year, which would be 13% year on year. And that we've got some really interesting models by one of my excellent econometric colleagues looking at GDP perceptions, changes in interest rates, which is driving this. But it's also a factor of what we saw in the last slide, that investment allocations were affected by denominator effects, the drop in the value of assets, the compression in the spread. Well, that spread is starting to recover again. Debt costs are starting to come down, and it's becoming a more attractive environment, an environment that investors are able to act on again. One of the other interesting things, one of the other implications for investors that we saw was, as a result of this drop in prices, a lot of equity will have been destroyed. And looking globally, there are approximately $3.1 trillion of real estate assets on which there will be maturing debt by the end of next year. Of that, there will be around $2.1 trillion of debt that will need to be refinanced. So it's a huge amount globally. You can see on the chart on the right the approximate split. It's not just offices, which I think is a question we've had in the past. Are offices the ones that are really going to be most affected? No, it's across sectors. So that needs refinancing. Fine, that doesn't tell the story in and of itself. Because of the drop in values, there will be a refinancing shortfall. Asset owners who wish to continue to borrow will need to inject equity. And we think that gap is somewhere between just shy of 300 billion up to almost 600 billion US dollars. Now, banks have been pretty clear that they don't want to step in and fill this gap. They already have substantial exposure to real estate. They don't want to take any more, particularly in the US, but also in other markets where they've seen big drops in value. So this creates a risk for the refinancer, but it also creates an opportunity. And it creates an opportunity for not just existing real estate lenders, but for other pension funds and others who have money that they can invest, could go into real estate, and they can invest across the capital stack. So they're getting exposure to new property sectors, to new geographies, purely on a lending basis rather than on an asset ownership basis. And we think that could be a good first toe in the water, or a good way for expanding your portfolio allocation, investing better within real estate. So we think this, although the negative around the refinancing of maturing debt and the need to inject equity presents a risk, there is also a great opportunity there for lenders, for pension funds, for can't even think what the word is, others with capital to come into the real estate sector. Sorry, my slides are not responding. I mentioned as well about financing costs falling and this creating a bit more of an opportunity. Well, I find it interesting when you look at how this opportunity is coming about, and I've put here examples for the US, for the Eurozone, what that baseline interest rate is. So you can see the Fed funds rate in the dark line and the ECB repo rate. Those are good reference rates, but actually, if you're going to be investing in real estate, you're going to be borrowing based on a 5-year swap, or you might have a treasury bond, a 10-year treasury bond or 10-year government bond as your reference rate. These are already seeing a drop, and you can see it's 90-odd bips drop in the cost of debt or the cost of refinancing compared to its peak. That's come down. Now, I think this offers opportunities, but if we look at this in a bit more context, that 93 bips is off a 300 bips increase in financing costs. And so it's helpful and it will come down further, but even lower interest rates are not going to make that financing gap go away. So that was the investment side. Construction, I think, is an interesting one as well. We've seen across the world, as a result of the pandemic and supply chain disruptions, a huge increase in construction material input prices. Now, I've put three regions here as examples. You can see timber as well, cement and glass as price index levels. And with the exception of timber, these prices have gone up and basically stabilized. And that's more or less our thesis going forward, that we have seen a big increase in construction costs. And it's not just in construction material prices, it's construction material prices, it's labor costs as well. These costs have soared globally. They've gone up for we don't think they're going to come down. We think this means, I'll expand on that point in a second. We need to adapt to this new operating environment. The inflation coming down is great. It means more predictable prices, but we're not seeing a reversion to the lower levels of prices we saw before the pandemic. You can see in this example here, there has been some drop in the price level for these commodities, but they're not going to be coming back down to where they were in 2019 or 2020. And this is true across material costs. You can see on the chart in the middle, labor costs and labor availability has changed post-pandemic across a lot of markets. A lot of people have changed sectors. There's a lot more demand for construction labor as well as other, or demand for labor that's attracting construction workers away from it. There's the higher debt costs, the higher funding costs. So the overall costs for any new development, any new construction project has shot up. This is compounded by changes in the sector that mean new construction projects are more expensive in terms of their content. And this is technological requirements. This might be greater office fit outs or more technologically advanced. And often that means more environmentally friendly warehouses. So this ties well in with the second one. So there's greater demand for sustainable buildings for those, and I mentioned offices before, for those with ESG credentials, wellness credentials, those in the best geography. That's true across the retail sector. It's true across the industrial sector as well. And as we build in more green materials, which need investment, need research and development, need ramp-up time, as companies, developers move towards these to building greener buildings, they are going to be more expensive too. So when you bring it all together, the construction sector is facing a big increase in costs, in operating costs, in bringing a real estate asset to market across pretty much every parameter. We don't think that's going to ease up, partly because we don't expect any reduction in demand. Pipelines are long, there's a lot going on. International supply constraints won't ease. We don't think there'll be any ease up on the labour side. There might be some short-term measures from one country might be able to benefit from another, but we have aging populations. We have construction workers that are less attracted to the industry, have other places they could go. Interestingly, this is less of an issue in Asia Pacific, but I think there's about a 3 million worker shortage in the EU and even more than that in the US. And lastly, global disruption. So rebuilding after wars, after Ukraine, will come with big costs, big price tags for the construction industry in terms of it will suck in a lot of investment. It will suck in a lot of materials, which would need to come from somewhere. And so that's going to mean longer term, we don't really see any let up in that negative impact on the construction cost. However, the flip side of this is if developers move up the value chain, if their offices, their industrial facilities, they're able to build those, taking advantage of this with new environmental materials, with the best green credentials, the buildings that they can come to market will be able to command, in the long run, the higher rents that will justify this investment up front. So despite the fact there's higher costs, if they're able to build the good quality, the best-in-class buildings, this will more than justify the investment. And I'll come, when I talk about ESG, into a little bit more on why that is, because there is a big demand-supply gap between what companies want, really good net zero carbon buildings, and what is coming in the pipeline, which has been cut back because of these costs. So hybrid. Interestingly, for hybrid, the global average is 3.1 days in the office. Employers say they're happy with that. Employees, on average, would like 2.9 days, which is a pretty even balance. I'm sure nobody's coming in for 0.1 of a day if they can help it. So it's similar within Europe. It's a little bit higher in the US, but it's also getting to an equilibrium. We saw huge swings, as I'm sure many of you experienced during COVID, and things have swung back over the last few years. You can even see just over 2022 and the first half of 2023, those who were in the office 5 days, that purple bar at the top, went from a fifth of workers up to 35%. Those who stayed at home all the time was up to 14%, down to 2% globally. And there are variations I mentioned within geographies. In Asia Pacific, where for various cultural and domestic reasons, such as typically smaller houses, less excess space, workers are generally back to the office 80 to 90% of the time. There is quite a bit of variation across Europe, but it's more like 70 to 80%, a little bit lower in the UK, a little bit higher in France and Germany. And in the US, it is lower still. It's more like 50 to 60% back on average, despite the fact that a lot of companies are mandating now that you have to be back in the office. And there is an interesting spread there. You do have a number of companies that have gone fully virtual, fully remote, and a number of others as well that have said, no, 100% have to be back in the office and have mandated days. I was speaking to someone on the weekend whose company have said you can only be in 3 days a week. So they don't want people in more than that. You can do less, but their target is have people in 3 days a week and then manage their portfolio otherwise. And this dynamic means that what the office offers becomes ever more important. So owners and employers are looking at, what do I need to do to my facilities to make them the most attractive they can be, to have people back in the office, and also to provide the best value, the best satisfaction, the best employee satisfaction. So from some of our surveys, we asked this question. It's like, what do employees consider the most important, and where are they at to in delivering that feature? You can see a couple of examples here. The importance, sound privacy being pretty important right at the top, but actually companies aren't delivering on it. And if you go over to the far right, having a chair in the office, pretty important, and there's quite a lot of satisfaction there. There's a bit of a gap, but it's interesting. There was I was seeing another client the other, sorry, it wasn't a client, it was a research piece the other day that said a lot of developments over the last few years of going to hot desking, going to non-allocated desks, not having chairs, having to do meeting booking systems, were particularly popular with employees. So employers were fine doing them. I was like, okay, well, this must work for us on a productivity basis because employees don't like it. Working from home was immensely popular with employees. And so a lot of employees said, oh, there must be something wrong there. We can't be making people happy. So hence the mandates to be back in the office 3 days or 5 days a week. But having them back has meant, as I said, that they had to look at what to do to make these offices as attractive and useful as possible. And the flip side, another corollary of the increase in construction costs, as well as the increase in price levels more broadly, is the money that companies have to spend will not go as far. They want to know what will get the biggest bang for their buck in terms of their investing in refitting an office or getting employees back. Do you go for the features on the left, like the sound privacy? Do you go for the features on the right, like a chair in the office or having a fruit bowl? And so there are different preferences by region. But it's interesting that companies are now looking at that more granular level to be able to achieve their hybrid ambitions, so that they can get people back when they want them, but also in a way that manages any downside to their portfolio or any change to their portfolio. A few other features, in fact, I'm going to skip over that. I'll have a quick drink. So that was hybrid. Logistics, I've mentioned before, is a sector where we have seen strong growth, strong investment in logistics. And one of the reasons is around globalization. Globalization, there is a lot of talk at the moment around deglobalization, about the reshoring or nearshoring or friendshoring. And in fact, if you look at quarterly earnings calls from the S&P 500, just since before COVID, we have seen a huge increase in the number of companies mentioning reshoring in quarterly earnings calls. Now, interestingly, in practice, this isn't likely to mean less global trade, just a change in the composition of global trade. It's not that everything is going to be back on domestic grounds and every company is going to be producing for a country in that country. It's just going to be changing of less in China, more in Mexico, less in Vietnam coming to Europe, more in Poland. And I am encouraged by, when you look at the actual volume of world trade, using the OECD statistics on the right-hand side, you could see where there are major recessions. But talk of globalization has not materialized in trade volumes. If you have a look on a level, on a price level, on nominal basis, you've got a lot of noise. You could see that world trade has been declining, but it's been declining because we saw a huge increase in the price commodities that massively pushed up their cost, and those global commodities have dropped back. So the value of that trade dropped, but the total volume of trades kept going. And if you were looking at any region, at the Americas, at Europe, and saying, what is the impact of deglobalization or reshoring, it will be more logistics demand within that region. Companies perhaps manufacturing more or manufacturing closer to home, and very likely holding more inventory in warehouses, having greater use of logistics facilities within their region of sale or production than they currently do. This is also being compounded by government incentives. So there's a big thing that, I mean, it's made huge amounts of noise over the last few years. The US Inflation Reduction Act, the US Jobs Act, which is basically a Build in America, Make in America legislation, big subsidies for green investment. And that is encouraging a lot more reshoring within NAFTA, within the North American Free Trade Area of Canada, the US, and Mexico. And it's not just the US is doing this. China, obviously very long-standing proponent of industrial policy, but also the European Commission is doing this. European countries are trying to do more to have greater funds available for attracting manufacturing and logistics back into region. And similarly, as the sector moves, it's becoming more eco-friendly. I mentioned ESG being a theme that runs through everything, moving towards more ESG facilities. Increasingly, retailers as well as investors will say, we want to have our online e-commerce offering, but we will only go with you if you can have net zero carbon buildings or full energy offset or something like that. So it's a growing requirement on the sector, but it's also making financial sense. As I said previously, with the construction industry, the costs of building have gone up so much. It's only those that are the most ESG friendly that can command the rents that justify it. And also consumer preferences continue to move in the direction that supports logistics. So urban logistics being an ever-growing sector as consumers' desire for products at the click of the button with faster and faster delivery is supporting that logistics demand, supporting urban logistics, more logistics offerings on a minute scale. And some of the interesting things that are being trialed, I'm sure you would have read about, from Amazon doing drone deliveries to other really short concept rapid delivery of goods on site in cities. That's not so much in rural areas, but certainly in a lot of the bigger cities. And urban logistics rents, partly because it's in an urban area, command substantially higher rents, and companies are able to pay the substantially higher rents because the consumer demand is there. AI and tech. Now, this is an interesting one. If we look within real estate, there is a growing amount of use of AI and tech and prop tech, as it's often called for short, within the real estate sector. I mean, CAD has been around for decades within construction, but using AI to do some more of the grunt work and some more of the predictive work. Greater AI, what's it called? Predictive maintenance, Internet of Things within the facilities management section. And as companies and their building investors want to have greener buildings, the sustainability side, the energy and waste management have a much greater desire, greater use of technology being incorporated into all these things. More data, better analyzed, including by machines and not just by people. So technology is a big trend. It's a long-term trend. It's one of JLL's 5 big trends for real estate over the next decade. And in the short term, AI is being a big driver. In fact, when we asked a lot of our clients about what technology they think will have a big impact over the next couple of years, you can see on the right, clean energy solutions, machine learning and AI, generative AI, and low carbon materials and construction. Those are going to have the biggest impact, but they're also the ones that they know least about. So these are areas that the sector needs to educate itself on. Companies like JLL are educating ourselves on so that we can talk to our clients and advise them. But more broadly, it is a big change that's coming in the sector. And as demonstrated by the chart on the right, we don't know how it's going to have an effect. There's huge amounts of opportunities. We've just got to see how it plays out. One of the things that we think will be the case for this year is AI was hype in 2023. ChatGPT came out, it got a lot of attention. There was a lot of talk about it. And as we saw in the last chart, people think it'll have a big impact, but they don't know how. We think 2024 will be the year that actually this change starts to happen. And it starts to happen in two directions, from being a top-down strategic decision where the C-suite say, we need to implement this, we are going to use this to innovate, as well as that organic bottom-up adoption by the workers to incorporate it. And now this is a bit of an aside. I had my first negative experience of ChatGPT the other day. I was interviewing someone for the job, and I could see them typing in the questions and then reading out answers moments later. It was very clear that they didn't know the subject until ChatGPT came back with the answer. Obviously, that's not going to be the case in the real estate sector, but AI, we think, will be starting to be strategically implemented from this year. And so the impact it will have, it will take a couple of years to play out, at least in terms of the material impact. In terms of the impact that we expect globally, well, it's quite geographically spread. You can see here that, you know, US Bay Area with the Amazons and the Googles of the world, no big surprise. It's huge. Certain areas in Europe experiencing, Tel Aviv in the Middle East, well, you know where Tel Aviv is. Tel Aviv being the only country getting substantial AI investment in the Middle East, and then likewise in China. China being a big international hub for cumulative AI investment as well. And if we have a look at what this means for property, AI is having a big impact on real estate demand. Now, I mentioned the green shoots at the beginning about tech and AI having a big impact on US adoption or US take-up of space. Well, we're seeing it. We're seeing it spread out. You can see, as this map shows, a lot of different areas really benefiting from this, particularly the Bay Area, but other gateway cities benefiting too. And if we look at what's happening in terms of bringing it down to numbers, there has been a huge increase in AI's real estate footprint over the last couple of years, a 37% compound annual growth rate. And if you look on the chart on the right, it's not just offices. Offices are a big part. It's for the workers, it's for the engineers, but it's also the industrial facilities, the flex office as well. But the industrial facilities for data centers, to build the technology they need to host the data centers. It's interesting that it is so spread across the different sectors. And that was technology, that was the impact of AI. We only think that that is just going to continue to grow. US being right at the forefront, but data centers cannot just be in one country, they need to be within region. And there was an interesting thing recently. Norway put out almost like a marketing brochure about why it's such a good location to host your data centers, because it's cold and data centers create a lot of heat. So that makes it good. 2, hydroelectric energy being cheap and plentiful means you can run your data centers at very, very low cost. So you might see some very interesting emergence of big data centers within that tech space and cloud computing as a result of AI coming into areas that might not have historically been big centers. Now, ESG, this is my penultimate one, and we're doing okay for time. So ESG, as I said at the beginning, is a thread that runs through all the different trends. It's so prevalent across real estate, for occupiers, for investors, for everything, that that I can't do it justice, that I will just touch on some of the ways in which this is having a big impact. And the first thing to say is, one of the reasons ESG is having such a big impact on real estate is because companies are signing up to it. Companies are signing up to say to SBTi, which is a Science-Based Targets initiative, that we will cut our carbon footprint, that we will move to net zero carbon buildings, that will reduce our scope 1, scope 2, even scope 3 emissions. So that means your the CO2 emissions that you create yourself, that you create indirectly through your energy use, and that you create in your supply chain. And the number of companies signing up to these commitments is basically growing exponentially. With that comes their demand for space. Also, we've signed up to this commitment. We need our real estate portfolio to be net zero by 2030 or by 2025. Oops, and it's not just, sorry, that was all a little bit too fast. It's not just companies doing this, cities are doing it too. Cities are adopting net zero carbon targets, saying that they will be net zero by that date. Now, I'm skeptical that London's going to be net zero by 2030, but it is an ambition. And if you have all these companies signing up, all these cities saying that they are going to move to net zero, this is a huge, or this will have a huge impact on space, on spaces, on the work environment, the home environment, the how buildings are insulated, how they're heated. And I mentioned before, talking about construction, how although we've got this massive increase in construction costs, rents will justify the investment in development if you look to the future. And the reason for that, I've tried to show here. If we look at companies' net zero carbon requirements or low carbon occupational requirements out to 2030, you could see the amount of space in million square meters demanded and the amount in the pipeline. So taking the US, 7.1 million square meters of space demanded based on companies' stated commitments by 2030, 1.8 million in the projected pipeline. So there's a 75% unmet demand. In Europe, it's 57%, similar in Asia Pacific. The numbers are a bit smaller. There is a huge movement towards net zero carbon, towards ESG requirements, and this will push up rents. And we are already seeing, it used to be called a brown discount. So if you had a bad building in a bad area that was not really green in any way, you couldn't command the rent that you might get of a building next door that's a bit better. And that was a brown discount. Well, we've seen brown discounts as well as green premiums. And that green premium is growing wider and greater as ever more companies are signing up to those science-based targets and initiatives, as cities are signing up, say we need to change our portfolios and we need this green space. One of the downsides to that is knocking down buildings and rebuilding has a huge negative impact on what's called embedded carbon. And there was an example recently from Marks and Spencer's, which is a big sort of supermarket chain within the UK, quite upmarket. They wanted to knock down their flagship store on Oxford Street in London and rebuild it with a really green, better quality, environmentally friendly, wellness certificated building. And they were told, no, they can't do so by the government of the day because of the impact on embedded carbon. They're challenging that decision. But I find it interesting to look at that challenge. Yes, we want to move to a lower carbon future. Companies have signed up, cities have signed up, but there are some big trade-offs in there as well. And interestingly, when you get down below that headline figure, there's difference by sector. And so you can see here, what's the sectoral demand for low carbon office space by government and finance, banking, professional services. Those are the bars. So the bars show what the total space requirement is. And then the little dots are how many companies or the share of companies or the share of, if it's not companies with government, the share that have adopted commitments. So it's a bit lower in professional services, but it's very high in government. And so you can see that this is the fact that we are up above 60% nearly across every category, shows the vast change that has happened within the last couple of years. Before COVID, these would have been down in the 10-15%. It would only been the companies really in the very, very vanguard that had already made commitments and were moving towards them. Now, the interesting side of this, the corollary to this move to better quality green space, is accelerated obsolescence. If you look at the top right of this, the image in the middle, you have the best quality space. You've got the prime, the core, the super prime space, which is in the best locations. It's got the best green credentials. It's got the best wellness credentials, so on and so forth. It's new. There is a lot of demand for this. And there's quite a lot of demand for the core space as well, which might be a little bit older, might not be quite as well located. And then some of the other value add stuff or sub-core. But there's a lot of properties that have been built before the 1980s, between the 1980s and the 2000s, which are in non-central locations, or even some of those in CBD that are just old. You can't refurbish them. You can't refit them. Can you even repurpose them? The buildings that fulfill the quality criteria will be in demand, have the highest prices and the highest rents, and the highest occupation. And we are seeing, as a result of that, earlier pre-letting, greater pre-letting, companies signing up, committing years in advance of the building even being started. And at the opposite end, you've got a lot of buildings that will be worth pretty much nothing other than the underlying land value, and you may not even be able to knock them down as a result of embedded carbon and other legislation. That's one of the big drivers for what we're seeing in the US, where there is a big drop in prices overall. Landlords handing back the keys to the banks, saying, you know what, my equity's been wiped out. It's not worth the investment. Banks cutting the price even further to just attract someone in. So interestingly, we think around about 15% of stock globally is at risk of just becoming obsolete in the next 5 years. And one of the interesting things for office space, which is probably arguably most at risk of becoming obsolete, is a lot of the floor plates, particularly for big offices, aren't suitable to be repurposed. One of the main things that they're being repurposed to is housing or living, but with central toilets, central lifts, and quite wide floor spaces, floor plates, and comparatively low ceilings, it doesn't translate well into converting office space into residential space. So those are the 9 trends of those sort of 100 I covered before. Briefly recap. Uncertainty. We're moving from a period of incredible uncertainty to one of relatively greater predictability. More predictable prices, more predictable debt costs, and improved growth environment. Green shoots, we're seeing growth starting to pick up. We are seeing some sectors, be it retail in India and China, or the tech sector in the US, starting to recover faster than the others, even though the economy is a little bit further behind. For investors, we've had a tough couple of years, but we think allocations are going to be increasing and that there are opportunities there for capital investors across the capital stack to enter new markets and new geographies. Construction, opportunities to move up the value chain despite the challenging cost pressures. And on hybrid, we're moving towards an equilibrium of sort of around 3 days in the office. And that means companies are looking to make sure their space is the best it can be, that it can attract employees back, and that they want to be there. And it doesn't just mean less space. It means less space for some and more space for others. Logistics is in the ascendancy as onshoring, reshoring, friendshoring, nearshoring all lead to more space in most markets. AI and tech is a big driver of increased space, and it will also be a big driver of prop tech and change within the industry. ESG is a theme that runs through it as companies sign up to more commitments and build those into their real estate portfolios. And then for offices, the best stuff is going to be in high demand. but there is a problem of obsolescence with the rest. Any questions? I'm going to stop sharing my screen so I can see anyone who might be about, if they have any questions.
I have two questions for you. First of
Please.
all, one is very interesting for me. You said that the people that you interviewed use ChatGPT. So were the answers correct?
The answer was so good, I thought there was no way that you could give that off the top of your head. It was a sort of, I was recruiting for someone junior, and they gave an answer that would take me an hour or two to come up with in terms of all the stuff that they said. And I thought there is no way. Partly because everything else they said was just it didn't fit with the way that they had spoken about themselves. They were not that articulate. And also, interestingly, because ChatGPT, the end of its training period is like 2 or 3 years ago, it's not up to date. So on a question about what's going on at the moment, an answer that ends 3 years ago stands out as being mistaken. But it was very interesting. And sorry, and your second question?
My second question is related to work home and in the office. We see that in the high-tech industry, there's not a lot of how should I say it? People move from company to company, and if they don't work at the workplace, if they work at home, they have less connection to the company, and less then they can do other things, or they are not really connected to the company. And is it the same in Europe or the States? I know in the States they're trying to bring them back to the offices, but how does it go in Europe?
I would say there is a spectrum. You get everything from companies that have gone fully remote, they've given up their offices, and they have no intention of changing that. They are happy with that. They are happy with their worker productivity. They get together in a different way than everyone coming to an office. We've had some examples where there was one at an event and a client said, we don't meet in the office anymore, we'll meet in a different location. So you know what, let's say we all live in 50 miles radius of each other, we might meet to do some work and do a social activity, to do some more team building. It doesn't have to be a tiny amount at the office, it'll be done in a different way. But also you've got, at the other extreme, you've got those companies that went fully remote during the pandemic and are completely not happy with it and have gone back to say you have to be in the office. And there is a bit of a trend there of the banking sector. Those conservative working institutions, they're some of the ones that swung back, and they thought it would work, and then have, I think Jamie Dimon of JP Morgan has been very clear and said, you've got to be back in the office, we want you there. There is a recognized problem for even those in the middle, to your point, that we want our employees to be collaborative. We want them to work together. One of the reasons that they want to move to that we are seeing this transition to better quality workspace, that better quality workspace isn't nicer desks and chairs and individual pods. It's a setup that is better for collaboration, better for innovation, and for interacting with your colleagues. So it's not lots of little meeting rooms and individual cubicles. It's more open spaces, movable furniture, whiteboards, drop-down microphones, space that people can collaborate better than they can just standing around a desk. And so we have had clients say, what, you know, I've only got a smaller pot now because everything's become more expensive. What features should I invest in to be able to get the best from my employees? How do I make them more collaborative? How do I make them more innovative? And I think we've got some ideas, but it's not really my area. So I know that there are some of my colleagues work on that full time and they consult with companies on that. But it's quite an individual answer when it comes down to the company level. But you're right, you highlight a problem of company culture, and some are struggling with it.
Thank you.
I see that there is a question in the chat. I saw someone raise their hand. I'm not sure I can see that.
Eitan Moore, I think.
Yeah, thank you. First of all, David, thank you for your lecture. It was very interesting. Did you have the chance to think what are the black swans hiding behind all of this data?
I'm glad you spotted them. That was my little almost joke in the diagram. No, that's the great unknown. We cannot predict what the black swan will be. I think there are people who are far more intelligent than me who are looking ahead to try and predict those. I'm not one of them, but not the black swans. If we were to say, what are some of these challenges on the horizon that could disrupt the outlook? I mean, at the most basic level, from an economic perspective, we could be completely wrong about inflation. Economists were completely wrong on the way up. They could be completely wrong on the way down. It could be a lot higher. That will then have a particularly big impact on retail, a big negative impact on cost of living. It would also then have a big impact on interest rates. So for the last 3 months, there has been a massive consensus that interest rates are coming down. And during that time, we've seen stronger inflation in the US, strong growth numbers, strong job numbers, and that picture could change. So if actually interest rates went up because inflation went up again, that would completely change all the forecasts. The recovery, the rebound in growth is predicated on a lower interest rate environment. The rebound in real estate, certainly in the investment side, is partially predicated on a lower interest rate environment. If interest rates went up, then we might face another year of incredibly low volumes. I'll touch on just one other, because you could pretty much pick any variable and pick a black swan or a scenario, would be population. So one, population movements, but demographics. We've got aging populations. We saw a big shift in some countries as a result of the pandemic, people leaving the labor force and not coming back. If you were to get another unexpected shift in that, then that could have an impact on wages if you don't have enough workers. It could have an impact on political policy. We've seen a big shift to the right in a lot of European countries, and a lot of in America as well, as immigration's become an ever bigger issue, or at least publicized as a bigger issue. And a shift rightward in policy could have damaging economic effects.
Thank you.
Thank you for the question.
Can I ask a question?
Please.
Which of those 9 trends that you mentioned do you think will impact the most Israel's real estate market this year, 2024?
For that, I might call on my colleagues who are in Israel and have a much better knowledge of the market than I. Moore, do you have a perspective?
Hi, Lana. Unfortunately, we don't have a research team in Israel, but we are operating in Israel as well. So, you know, the trends would be quite the same: residential, industrial. It would be the ESG, unfortunately, is not a huge trend in Israel yet, but it will be, because we need to stick to the entire world eventually. But it's, you know, here in Israel, it's a lot of changes, not only the interest rates, not only the economics, also the war. So I don't think there is any prediction as for now. So it would be.
I can say that from things that you showed, logistics are getting bigger in Israel. Also related to AI and the storage facilities for computers and everything is also one of the things. These are two trends that are in Israel today. In the office part, we see a decrease in prices in Israel now, because a lot of vacancies, startup companies that are starting to evacuate spaces and try to do sublease some spaces, and a lot of buildings that were constructed or gone out the way to be constructed a few years ago and now maturing, and a lot of available spaces. So the prices are going down now in the offices.
Thank you very much for that. Ilana, are you of the same opinion? Do you have a perspective on which trends will have the greatest effect?
I think the uncertainty is definitely a very big issue. The elections that you mentioned and the war, of course. I do agree that the logistics is taking a bigger part of the market, and the offices are going down. But you know, I don't know what's going to happen with the interest rate. That is a puzzle. Maybe some people who have more information about that, I'd like to hear.
But the Efrat is the pro about Israel real estate. So and so Efrat, if you have something.
I think Weizmann wanted to talk. Weizmann is also a researcher from he used to be in Bank of Israel, right? Yes, Weizmann. Chaim. Chaim. לא שומעים אותך. As to the Israeli market, if there's question until Weizmann, Weizmann, now I think you have a problem, Weizmann. You was unmute before and you couldn't talk. לא שומעים.
Maybe it should be the subject for the next lecture.
I agree that we don't know much. We are in such a in-between period. We don't even, you said the Ilana election as though we're going to have an election.
Can you hear me? Yes,
okay.
But I don't hear you, so okay. Let's ask this question. You showed a chart which shows a quite significant rise in the labor cost in construction. I think it was about 35% or 40%, around this percent. Do you have any explanation for that? Why this rise in the labor costs in construction? You didn't note if it's Europe or United States or North America. It was a general chart, but I think it surprised me. Do you have any explanation for this high rise in labor cost in construction?
Great question. So this particular one is Eurozone construction labor costs. One thing I would point out is the axis is different from the commodity prices. So it's up 30% on 2015, but not as much, more like 10 to 15% on 2021. Construction, well, you've seen a similar, albeit slightly smaller, increase in Eurozone labour costs everywhere across the board, and partly that's inflation driven. Wages have risen quickly because inflation has gone up. So these aren't inflation adjusted labour costs. This is just your nominal wage indexed. So that's driven it. But also there's been a reduction, well, there's an availability problem, a skills shortage in construction across much of Europe. And partly that has been due to a lack of immigration. Within the UK, that's been a problem. Within a lot of European countries, they've had that. Even some of the Central and Eastern European countries that had a big influx of Ukrainian refugees, they were not able to fulfill their open roles, partly because of most of the people who came in were women and children. And at the same time, a lot of Ukrainian men who had gone abroad to work in Poland and Bulgaria, in Central and Eastern Europe, went back to Ukraine to fight. So that has exacerbated shortages in the low and semi-skilled professions. So construction being one, logistics and driving was another one. Quite why there's any other factors than that, I'm not sure. I think a lot of other sectors have been able to offer more attractive employment. So the same pay, but you're not going to be outside all year round, or slightly better pay. And so that has been a factor attracting people away from the construction industry. At the same time as the war has gone, or the war has taken Ukrainians back. Yeah, and aging population, albeit the construction sector isn't uniquely affected by that, but an aging population taking people out of the workplace. If you're in an office, it's easier to work for a few more years than if you're carrying bricks up a ladder every day. But thank you, good question.
Yeah, I think we are done with the time. We said an hour and a half, or we're a little over time even. So thank you, everyone. We even have maybe what we call in Israel Ta'am Le'od, flavor for more, for another meeting with better other questions. So thank you, everybody, for being with us. It was
thank you very much.
Thank you, David, for a very detailed lecture, and both very wide and very detailed at the same time. Thank you very much.
Thank you very much for having me.
Bye.
Thanks all. Bye-bye.
Bye-bye.